So HOLT's a corporate performance and valuation framework. It's used extensively by buy-side institutions. Over 600 of them use it globally. It's a proprietary framework that sits in Equities at Credit Suisse. We are a team of 85 professionals that sit across the globe. Our framework effectively rests around a proprietary measure called cash flow return on investments. It's very much like a ROIC, except it's cleaned up for non-cash items, accounting distortions. It's expressed in real terms. The benefit of that is it allows us to systematically assess companies on a like-for-like basis across geographies and across time, which means, of course, that we've been able to scale it up. And so we have 20,000 companies that we look at globally. This gives us, we think, the broadest amount of coverage. We have 5,000 stocks in the GEM area. And in Africa specifically, we have over 200 stocks. So this is 50% more, I believe, than any of our competitors out there. The second point is we have very high quality data. The reason I say that is our investment professionals are all MBA, CFA types. They understand the companies they look at from an economic standpoint. So they're able to clean them up by understanding the true underlying performance of the businesses. And so therefore we have what we think is a very credible offering from a quality standpoint as well. I think the biggest frustration that we've tended to have is there's an obsession in the market with PEs and earnings. I think it was Warren Buffett who said, give me an earnings number and I'll hit it. The reality is anything that's earnings-based, yes, it's easy to understand, but it's also the number that is the most prone to accounting distortions. The topic gets even more philosophical in that invariably corporate pay schemes are tied to hitting accounting-based targets. So stakes can be that much higher in terms of hitting these numbers. I'll give you an example with EPS, which is probably the most prevalent figure that people look at. Sweat your asset base, for instance. Don't invest when you should. It is a clear issue today when we look at data across the world. By doing that, your depreciation expense is going to be lower. So in the short term, you can absolutely boost your earnings in that way. While you're at it, why not throw in a big buyback, right? Your earnings per share is going to move up, and therefore you're going to be looking pretty good if you're looking at that particular measure. So we see some serious issues with that, and so it's important for us to take the data, clean it up for these non-cash items, clean it up for the accounting distortions to really get a proper measure of what is the cash that a business is generating off an investment at the time it decides to invest. That, in our view, is a much clearer reflection of the performance of a business. Certainly the back tests of our data would suggest that as well. Looking at equities in Africa, and I think where HOLT becomes quite handy is we have over 200 stocks in Africa, so it allows us to start looking at what some of the trends are. Because we have a lot of historical data as well, we're able to see how valuations stack up relative to history and relative to peers. So effectively what we'll be looking at in the presentation from an equity standpoint is highlighting some of the opportunities in Africa. The key one, of course, I'm not inventing much here, is it's one of the few pockets of sustainable growth. The IMF data is still forecasting growth to be relatively high compared to certainly the developed world. And longer term, the CS Wealth Handbook certainly highlights that the wealth potential is certainly subpar right now. So the share of wealth in Africa is outstripped by the share of the population by a factor of 1 to 10. That poses a lot of challenges in the short term, but in the long term, given the growth in population, certainly given the growth expected in the workforce, the wealth effect there could be particularly positive. And so it's important in that context to possibly look for longer term investment opportunities. In the short term, yes, there are some challenges linked to the commodity cycle. Yes, there are challenges linked to potential rises in interest rates in the US, but longer term finding these quality names that can play into the structural growth story becomes a relatively enticing investment opportunity, we believe. You have to bear in mind there are two challenges with African equities. First of all, ex-South Africa, you will find problems in terms of disclosure, so the transparency in terms of the financial data that's available is not always on a par with what you'd expect in the US or Europe. And second of all, the liquidity of the stocks is often such that the interest of equity investors is possibly not there as well. So really what we're focusing on, we aim to have 98% of the global market cap covered in HOLT. In Africa, we have the areas that have the best transparency in terms of data, but also in terms of liquidity, they have to be investable. Yeah, so it's, as we look at the data, 200 gives us a good sense of the trends. If I look at African equities today, they have some very specific sector characteristics. Overwhelmingly, the exposure is towards financials, consumer staples, and materials, telecoms to a certain extent, relative to what you would see as a market develops and becomes a fully fledged emerging market, then moves on to become a developed market. You would expect the trend to de-emphasize these sectors and move much more towards IP-based type sectors. The likes of pharma, industrials, and IT are much more prevalent in terms of sector mix in developed markets. Why does that matter in the short term? I think if we look particularly at financials and materials, these tend to be relatively lower return sectors, and they tend to be more volatile sectors as well. So in a market where, yes, there is still geopolitical risk, which tends to lead to higher risk aversion from an equity investment standpoint, there's an added challenge from an equity standpoint, which is the sectors you're going to be looking at tend to be more volatile, tend to be lower return, which again tends to command a valuation discount compared to the more stable returns by definition. So going back to the point that we focus on liquidity and interest, South Africa by definition is going to be the area that we look at. We have about 140 stocks in that market, covering all the main investable ones. Again, as we work with clients who are invested in the area, we would add others as their interest grows. South Africa, we have to somewhat differentiate from other frontier markets for several reasons. First of all, the sector mix really has features of both frontier markets as we see it in Africa, a lot of financials, a lot of consumer staples, but it also has good pockets of IP-based industries, notably in IT in particular. So really it has characteristics of both. You could say it's a bit of a barbell. It's got a best of both worlds. Of course, it also has its own challenges where growth in frontier market Africa is still expected to be relatively robust. Growth in South Africa is slowing down quite aggressively. We've seen it most recently in the CS Emerging Market Consumer Survey, where the levels of confidence are probably among the lowest of all big emerging markets. In a HOLT world, what do we see in practice with that? South Africa as a country has had very high CFRI, so very high returns, but they have been trending down for 4 years. The expectations over the next 2 years are for further pressures. Consensus has been incredibly negative in the revisions it's pushing through. And so therefore, as much as the market has tended to rebound somewhat in the last year, the fundamentals are still not particularly strong and certainly not strong enough to underpin valuations today. So some relatively grim picture here. Now that's the bad news. Of course, the good news is there are pockets of stocks that are good, sound wealth creators historically, and where the market expects these to continue to grow wealth going forward. The likes of Mr. Price, for example, would be a good example here. We ask all the questions that allow you to calibrate how aggressive or not markets might be in terms of expectations relative to history. We leave it to fund managers to come up with the tough decision of saying, is it relevant or not? Now, what we're able to still do is say, okay, how do things look like relative to history? The big challenge when we look at global valuations today are twofold. First of all, as we know, margins are at all-time highs. Is that sustainable? Second of all, we've been in a period where growth has been incredibly robust. Again, is that sustainable, with the added issue being that so far margins have held up, but companies have tended in large part to invest in growth, even though sales have not necessarily followed through. Now this matters because it tells you that capacity utilization across many sectors and many geographies is actually subpar. That's been okay from a cash generation standpoint while margins have been high, but if these start to drop, there's an issue from a cash flow generation perspective. The second issue is if sales don't follow through, this problem in terms of capacity utilization potentially accelerates. We see it with the likes of luxury goods in particular, with their huge ramp up of store growth in Asia. We see it more recently with autos with a similar dynamic there. So that's a problem from a corporate performance standpoint. From a valuation standpoint, markets are still tending to reflect relatively rosy outlooks for returns and for growth. And so that's the dilemma today is it sustainable? Now, we've been flagging that for 2 to 3 years. The reality is the dynamics in which we're operating today are very different from anything we've seen historically. There are no asset classes other than equities that are yielding the type of yield that we see today. Going back to the point I made earlier, HOLT can calibrate what the yield is in an asset class. The real yield of equities globally is right around 5% in real terms. You're not getting that kind of yield in developed markets anywhere else. And so you have this tug of war between equities where implied expectations and the outlook for cash flows might be demanding relative to history, but very few other alternatives, and effectively this tug of war between, yes, things expensive today, but no other alternative in other asset classes.